Our next guest shorted Apple ahead of its earnings, doubling down after market after warning of a sluggish holiday quarter. Joining us right now for a closer look, Dan Niles, Satori Fund founder and portfolio manager. Good morning to you. Of course, we've just been walking through some of these employment numbers that are impacting the market. Things actually, for the most part, actually looking a little bit better right now across the board. But let's talk Apple, since that's one of the most widely held stocks in this country and in this world right now.
Sure. I mean, I think if you look at Apple out of the Magnificent Seven, it probably had one of the worst releases, because if you just look at the top line revenues have been cut every single quarter this year that they reported. And that wouldn't matter, except you're asked to pay 28 times PE for 2% revenue growth last year and negative 1% revenue growth this year. If you look at the alternatives you have Google and Meta growing between 9 to 14%. On the top line. You can pay 22 times for them. Microsoft's growing about 11%. That's at 32 times, but at least that's got an AI kicker. And the S&P overall is growing about revenues at 6% and trades at a 20 PE. So there's a lot of other stocks you can choose from where estimates are going higher. Amazon's actually our favorite of the Magnificent Seven because operating profits, they beat it by 40% when they reported. And so, we own Amazon, we own Meta, we own Nvidia, we like Oracle, not in the Magnificent Seven, but a cheaper way to play AI. And so I think there's a lot of alternatives beyond Apple where you get growth and a reasonable valuation.
So looking at Nvidia right now, $440 a share, what do you think that can go to at this point?
Well, Nvidia in some ways is the toughest one to figure out because in the short term, I think they're going to have blowout results again. The numbers are going to go up huge. But the issue you're dealing with, and this is something I'm struggling with, is that investing is hard enough. You don't want to be fighting the U.S. government at the same time. And unfortunately, that's what you're doing because they're saying Nvidia can't ship to China. That's 25% of Nvidia's data center revenues. And so not this quarter, not next quarter, but sometime next year, you're going to run out of not being able to supply all the demand in every other region on the planet. And then you're going to have to figure out what the right growth rate is. And don't forget, there's other people like AMD and Intel, very far behind, but who are also trying to get a piece of the AI market. And at some point, that spending will slow down. I mean, don't forget, about a year ago, Nvidia was pre-announced, massively missing numbers and cutting forecasts because data center revenues had slowed down. So Nvidia is the one that I'm still kind of thinking through right now, and do I want to fight the U.S. government? And that's why it's one of the smaller positions we have.
Meta, is that a value play at this point?
I mean, it's both. That's the beauty of Meta. And so that, along with Amazon, are our two biggest positions, because you've got 14% revenue growth at Meta. You've got it at 22 times. You've got a stealth AI play built into it because they're using AI to help recommend videos to people to watch, and they're using AI to help increase the monetization of their ads. So you've got both at a very reasonable valuation, and so that's why along with Amazon, we like those two quite a bit.
Dan, I know we always talk stocks with you, but just macro, I'm very curious what you think of both the jobs number that we just heard about and what you think the Fed may do about it, and how that is going to impact risk-on, risk-off kind of assets like the ones that you're talking about?
Sure. I mean, I think the biggest thing on the macro side is what happened on Wednesday when the U.S. Treasury said, hey, we're going to issue more bills at the short end and not at the long end. And you saw this massive rally in bonds, and you saw the 10-year, which at mid-October was sitting at 5%, with the payroll number today at 150 versus the 180 people had been expecting, unemployment edging up a little bit. We've posted before, we think we're going to get a year-end rally. The market is entering its best seasonal time of the year. November, December, January, over the last 50 years, it's up 4% in total. Over the last 100 years, it's up 4% in total. Okay. And the odds are even better when it's down going